the key learnings that we made inside the investment committee over time, having the discipline to hold your winners. And winners, it's not necessarily stocks that went up. Eventually that converged, but winners for us is business that can compound because they know how to reinvest. And as they reinvest their earned capital, the moat is increasing.
So Medici has had this phenomenal track record since its founding, as you've compounded capital at 16% per year since the start of 2009. And that's versus your benchmark compounding at just 11.3%. And Pierre, you've been a part of a lot of that growth as a portfolio manager at Medici. And I wanted to start from the beginning. So after you started your career in industrial design, you then transitioned to the investment industry when you joined Medici in 2011, and that was just 2 years after the company's founding. So I'm curious, what did you see in Medici at the time, and how did you know it was the firm for you, given that you were really just getting started in the world of investing professionally?
Yeah, great question. There was nothing much to see. In terms of track record, there was almost none. The firm was starting. And from my point of view, I wanted eventually to leave industrial design to pursue that investment career, but I saw it as something that would come far away in the future. And so I would do industrial design as my daytime job, and on evenings and nights, I would do investment, just like probably a lot of the people listening to your show do from home. And so Cal Simard and Danny Foster, they were attracted to my profile. So they founded Medici 2 or 3 years before they met me. And I was writing a financial blog just to, have connections and speak with, people that know fundamental investing. And they were attracted to my profile just as I wrote that blog. And Cal Simard on his side was writing in the local newspaper in Quebec and Montreal. And he would talk about, businesses, good ROE or return on asset businesses. I recall that he even wrote a paper about, if Warren Buffett invested in Quebec companies, what are the business he would look for? And I recall names like Quincaillerie Richelieu, Alimentation Couche-Tard, CGI Group. So those are names that you're probably aware of. And he thought positively about some of the same things as I do. So seeing the markets as a way to buy businesses, not pieces of paper, understanding business models, taking care of clients, the same way that if we were clients, we would want to be served that way, not charging outrageous fee. And we did know after meeting a while that, if we did the job properly, then we would be rewarded having those, changing our clients' life for the on the positive end of things and be rewarded financially. But I think what was most unique about Medici and how we started is there was no star investor leading the way. So I think most investment firms today are born from, an employee from an investment firm that chooses to leave the firm and go on its own. And so he knows the recipe, he knows the processes, and he would find people, on back office functions to help him, keep looking at stocks during the day and so on. So there was no process like this. Everything had to be done. Even Cal Simard, who founded the company, he did not came from an investment standpoint, from another investment firm. He was, he learned actuary because at a young age, what they taught him at school, it was basically that the markets were efficient and you could not generate any, meaningful alpha over the long term. So he was like, okay, so if nothing can be done there, then I won't pursue that career. And so, all the process, we had to learn them. Cal and Danny did know they had to have great people, great processes, And we didn't know how to do it. We just figured it out as we asked our clients questions to see what they wanted. And in terms of investment, we just looked at what the best were doing. If you want to be good at hockey, you should watch Connor McDavid or Sidney Crosby videos. Well, that's the same thing for investment. You should watch Warren Buffett. You should watch, Phil Fisher or Charlie Munger. Anyway. And one thing, maybe one anecdote before, passing on the other question is, I remember Cal and Danny asked me on my first interview, do you manage your own money? What is your return so far? And how do you calculate your return? And I was like, gosh, this, I was thinking about, hard questions to answer. I was like, well, that's super simple questions. But what I learned later, maybe a year or two after, is all the people that were interviewed, they didn't even invest with their own portfolio. They would buy mutual funds, they would do indexing. And so when you think about investment, probably even more in Canada and Quebec, it's fascinating to see how much industry participants aren't even trying to beat the market. And even the ones that say they do try to beat the market, you look at mutual funds, there's 7,500 stocks in that. And so if your best idea is, 4% of your portfolio, are you really in the business of having, significant, meaningful returns? So of course you'll underperform. If you charge fees and you're close at indexing, you'll underperform. So I was surprised by that. I said, well, here comes a great business that's coming at me, if I could say it that way, because, we could add value if we do it properly.
That's wonderful. And yeah, I think you mentioned sort of the team aspect of not having sort of one all-star running the show. And I think that's one of the unique things about Medici and how you've managed to generate these outsized returns is you use this investment committee to, make investment decisions. So I was curious if you could talk about how the committee works, how it's used to generate investment ideas, and then how an idea eventually enters the portfolio.
Yeah. Well, the committee in itself is not doing much research work. The research is done by analysts, and amongst the 5 members of our committee, there's 3 analysts that are, mainly working full-time, looking at stocks and stuff. And so the reviewing is done by the committee, and all the buy and sell decisions are done by the committee. And by the way, having 5 members is we feel like it's the good amount of people. Too much people, it's mostly like a survey of public opinion. You don't want that, okay? You want a team that's nimble enough to be able to take bold decisions. And if you've got 10 person around the table and you want to put 10% of your money in a stock, it's going to be a quite hard task. And having, only one people on the flip side, the problem is you could have, we want to avoid failure for our client. And if you end up putting 25% of your client's money in a single stock because you're super confident in a given investment and you don't have anyone to challenge you, if you fail on that idea, then you could lose a bunch of money for your clients. And we're not in the business of asking our clients to give us, 10% of their assets. We want to manage their whole financial life. So we have to generate enough trust for them to do that. And so, being able to put 10% in a stock is significant enough, but having a too small committee would put us at risk, we think. And, going into our strategy, because the strategy is being applied by analysts, but also by the committee. We're fundamental investors, and all the members of the committee are really investors on themselves. They have their own portfolio. They make their own decisions for their own money. And when we find something attractive, we want it to be significant. So we own maybe 15, 20 stocks, more or less. We've got only one strategy, okay? Not 5 strategy. We're not trying to sell the best strategy for every client. We have one strategy, we present our strategy, and if someone interested in what we do, then you can come in as a client. But if that doesn't fit, it's fine. We don't want to serve everyone. And we're bottom-up generalists, so tech, pharma, financial, industrial, we would look at all those kinds of companies. Although we tend to shy away from biotechs, resources, highly cyclical with fixed costs, or highly speculative, not revenue generating, we would shy away from it. Or the latest fashions. You think about Beyond Meat, cannabis industry, cryptocurrencies, Valley and pharma. So, we didn't invest in any of those things. And there's basically 4 criteria that we would look at. Good and sustained return on capital, ideally even during recessions. Meaningful and durable as in expanding competitive advantage. The third one is having good managers that are able to reinvest for the long term and at attractive rate of return. And if you got all those 3, it's great. You got a great business. But we're investors and we're there to make a return, and a return that's better than the benchmark. So we need to buy at a reasonable valuation. That's key. And the key learnings that we made inside the investment committee over time, and that circles back to your initial question, having the discipline to hold your winners. And winners, is not necessarily stocks that went up, eventually that converged. But winners for us is business that can compound because they know how to reinvest. And as they reinvest their earned capital, the moat is increasing. And so I wish I had been able to understand the importance of reinvesting earlier in my career. I was all about, trying to find the best moats. But sometimes you can have moats that doesn't allow you to reinvest enough. And so your return, although it's a great business that you own, your return are not necessarily as good as I might have wished at that time. And so the committee, being a group and being focused on compounding, always gets you back to that idea. Oh, okay, can that business compound? And we sold, we sold Apple, we sold Costco, and there's a bunch of business we sold, and we were like, gosh, we left so much money on the table. So I guess we've learned the hard way, but we haven't sold, one company, probably your audience is well aware of, Constellation Software. We've held it since 2012. So it's been, 13 years, 12 years. And it has been expensive much of the time. And, being able to see the quality of the business and having that criteria of reasonable valuation, not, a stock could be expensive, the business could be good, and you could keep it as long as it's reasonable. And so the committee really helped us learning, what stocks should be kept and which one should be sold, depending on the valuation. It's really hard to find true compounders. So, when that happens, they won't stay cheap, much of the time. So you have to accept to own them at more expensive valuations. And maybe the second key learning, or one of the key learnings, would be you research first. And then you try to buy at a reasonable valuation, not the opposite way. Sometimes as investors, we try to seek to things that have gone down. But if you don't know the business and things have got down, you got two things to figure out. You got to figure out the business, how it works, what's the management, what's the perspective, the long-term perspective. But the other thing you need to figure out is what's the problem? Is it temporary or permanent? So you got two problems to figure out. And what we've learned over time is when you do that process the opposite way, so trying to find things that have gone down, you're rushing on research. You're going quick because your thinking is, oh, well, the stock might go up and I could lose the opportunity. So we had our best investments looking at companies for years and banging our head on the table and say, gosh, when am I going to buy that thing? It's super expensive and it always been that way. But things happen. Problem happens in life, and maybe 5 years later down the road, you have your opportunity. There's a problem, but you can focus on the problem and figure out if you want to buy or not.
Yeah, so many great points there. I liked the point you made on just these truly exceptional businesses can be very rare, and we should be very reluctant to sell them. And one of the ideas I've sort of thought about recently is people can look at a company's multiple today, and it might be higher than what it's been in the past. And when you compare today to the past, it'll say, oh, like the company's more expensive. But if the company's done very well and the stock is up 4x over the past number of years, then that would tell you that the previous multiple you're looking at was a mispricing because something was being underestimated with that company's future growth. So looking at multiples can be a tricky game sometimes with these exceptional companies.
Yeah, but if it's like a muscle that you need to flex, the more you know about the business, and the more if the business is great quality, the more you come up to the idea that, multiple isn't that important. It might look expensive, but if hey, that company is able to reinvest at 20% rate of return, they're generating a lot of cash flow, they're reinvesting most of the cash flow. Generally, even a 30 times P, if you have such a business, it could prove to be cheap, but so reasonable is like, it's not black and white. So it's a judgment call, right?
You talked a bit about moats there. And with investing, one of the tricky things is we can find ourselves in these echo chambers where you're talking to the same people and you're all spouting many of the same talking points. How about you talk about how the committee has helped you find these exceptional businesses with truly sustainable, truly durable moats and competitive advantages? I'd love to learn more about this.
Although no research is done directly at the committee level, we assess the research and we ask a lot of questions. And figuring out a moat is, it's not always clear inside of your head when you get, information, oh, that's interesting. But, having to put it on the paper, having to write it, because if you're going to present at a committee, you're going to write something. And as you write it, you lay it down on the paper, you see if it doesn't fit. You're like, hey, well, there's that aspect that I forgot, or this or that. So your first committee is your own committee because you write it on a piece of paper. And there's 4 other person waiting for you, and that are gonna grill you, questioning you on what you laid out on the paper. So it's really a game changer. I don't know how many individual investor listen at that show, but having other people questioning you, there's always aspect that you will forget when investing. And, I have the chance personally to have those 4 people that are rushing me on question when I lay out a new idea. And it's a game changer, really. And as a committee, what do you want? Even as an investor, do you want to form your opinion on a single judgment, or do you want to consult, other opinions? And whether a moat or not can be easily disrupted, you can figure it out many different ways. Life experience can bring you stuff, knowledge of an industry, comparison with other industries. You might relate to some things that might be comparable. Past history, things happen in a given business, and you can learn from that. And even KYC, know your client. So the investment committee, there's a bunch of people there that knows, our 2,000 clients more or less. And, there's good chance that amongst that group of people, there's a pharmacist, a software engineer, a loan underwriter. And there's always people amongst our clients that we could get a lead from, get a call. They have a vested interest in giving you information and helping you forming your thesis. So the investment committee is quite useful at that also. And one of the things that the committee could be useful to is saying too hard. Sometimes you're passionate about what you do, you want to learn stuff, and you're not sure that you can understand a company, but you're willing to work on it. But you got 4 other person looking at you, and they're not able to give you any good questions because they don't know what's happening. They don't know what's that business. So sometimes it could be an indicator that you should maybe not pursue your investment idea because nobody's going to be able to challenge you, and we might do a mistake. So, and Munger, I think Clay, you like Charlie Munger. He said, "I don't believe in just sitting down and trying to dream it all up yourself. Nobody's that smart. So what do you want? Having 5 pair of eyes looking at a moat and figuring whether it's going to change fast or slow, it could be disrupted or not. Do you want to do that stuff alone, or you want to do it as a team? But you got to be open-minded if you do it as a team. If you're a young investors in the year 2000 and you were using web crawler, Alta Vista, Google, and all that stuff, you would probably see how, the phone book industry would be challenged. Whereas an older investor that wouldn't use those technologies at that time, the search queries, probably would think, yeah, the phone book business is the best business that ever existed, You don't want to be that person, okay? And having, at Medici, when AI came down, we had an AI expert coming and presenting to the committee and even the rest of the team, because we use now AI to upgrade our own internal process. But having the expert, we went from, Google is going to participate in the AI industry, and it's going to be a force for them because they've done it. They've done it already. And we were like, oh, gosh. Having that presentation, we were like, okay, they will participate, but they will be one participant amongst other. They will not be the only game in town. And so having outside expertise and having people being able to bring in outside expertise is key. An investment committee could do that. And if I could add a little more, not all moats are equal. And when the committee figures out moats, as we've learned to work with each other, we figured that some moats are expanding and some moats aren't, or even shrinking. One example is O'Reilly Automotive, which is probably a business that well in the U.S. We looked at it many years before we bought it. It was, I think, in 2018. Amazon laid out the news, or officially or not, I don't remember, that they would get into the aftermarket auto parts industry. And so O'Reilly went down, and then we bought it. But the some of the members of the committee were like, okay, that's a fair price. That's fine. But as the stock recovered over the next 2 or 3 years, we're like, okay, we should sell it because there's not much growth coming, and they won't be able to grow, and we should sell it as it's well valued. But there was another side of the thesis, and that was, we really learned from it, looking at the numbers, questioning the management, but also circling back with the members of the committee. It's that, yes, the market seems mature, but there's many players that haven't done the investment, doesn't have the distribution infrastructure to give out parts quickly. And every time O'Reilly opens a new store, they're displacing a legacy store, a mom and pop shop store. So even though it didn't look like they had the capacity to open store, many years in front of them, they did have that. And so we had some people from the committee that said, no, there's more growth upcoming that we think. And having that debate inside and having the patience to keep it, although the valuation might, look like it's not reasonable, we made great return, and we still own O'Reilly today.
Man, you really struck a chord with me there. Just having other people to talk about investing with and talk about these very complex subjects like moats. I had realized upon joining TIP that investing is can be a very lonely endeavor. And it reminds me of the community we launched recently, which is called our TIP Mastermind community. It's been such a valuable resource to me just to sort of have people to surround myself with to talk about these complex subjects, talk about companies, talk about moats or investment strategies. And I think it also ties in well to my next question, because one of the other aspects of your firm that I found particularly interesting is that your firm proudly states that many of your analysts, many of your portfolio managers actually didn't come from the investment industry. I'm curious to get your take on if you think this can offer some sort of advantage for your firm, whether it be the ability to think more independently or knock down some of the conventional thinking that academia can teach us, or what are your thoughts on that?
Yeah. I think with labor shortage, let's say first and foremost that you don't have if you find someone good coming from inside the industry, you don't really have the luxury of, not taking him or her. There's good people coming from inside the industry. So my point is not to trash against it, but our industry, at least in Canada, I don't know if it works the same way in the US, but it's much more about selling than investing. So if you get people from inside the industry, experienced people, they're probably well aware of how to sell a fund to a client. Investing, maybe not as well. At school, they learn us the efficient market hypothesis. So circling back to the first question at the beginning, you learn that you cannot beat the market, or you shouldn't try to beat the market. And so the people that end up learning the fundamental investing, the concept of intrinsic value and having a margin of safety when buying assets, it's the one that have figured it out by themselves. And they come from outside the industry generally. So if you look for a given profile, generally you'll find people coming from outside. Doesn't mean someone at school wouldn't have the curiosity to pursue fundamental investing, but
I think another good point there is tying back to that interview question is like, show me your portfolio. What have you bought? Why'd you buy it? How is it done? It's essentially asking or it's getting to the point of, is this person truly passionate about investing? If they're buying a mutual fund with 5,000 companies in it that has all these fees, maybe they aren't as passionate about investing as they might say they are.
Yeah, you might be passionate about financial planning, for example, but investing, I'm not sure. Not sure. And so one of my colleague, Eddie, he's my partner. He was so happy to get that portfolio management course at university. He was like, "Oh wow, I'll learn investing," and he already invested by himself, by the way. So he had seen it like as a way to enhance learning, and he just figured out that, wow, it's all about standard deviation and beta and Greek letters thing. And, he was like, I'm not investing in Greek letters. I'm investing in dollar sign. It's not Greek. It's American. So we're joking about it. And for many of us, it's been so painful because we went from outside the industry, we went in, but then you got to get a diploma or something. So I had to do the CFA charter. And again, I don't want to talk against it. It's a complete, training that you have about the financial industry. It's super complete, but it was exhausting. And I was like, what? Why do I have to figure out all that stuff when, I can do fundamental investing? I know I get great returns, but I have to learn Greek letters as an example. So it was exhausting. It probably slowed me down a couple of years when I joined Medici. But I guess, just like you said, you probably find more passionate people outside the school and the industry. And if you hire from inside, you'll probably have to convince them changing habits. And changing habits is sometimes a little hard to do. And by the way, maybe one idea that is worth saying about the investment committee is it's not going to be a good committee if it's run by a dictator. If it's one person taking the decisions and the other person are just there to give out opinions, but there's only one person who decides, what it'll do to the long term is those people that are just giving out opinions, they won't trust the process and they won't speak out their minds because anyway, it doesn't have any effect on the end decisions. The person will end up deciding what he or she wants. So the diversity, and it might sound cliche, but the diversity of opinion has to be encouraged. Nobody should feel threatened by speaking their minds, even if, the four other ones are against what you're about to say. And if you don't do that, you lose the benefits of the diversity and having different viewpoints, and you end up wasting people's time. So everyone loses. We have a culture of actively looking for disconfirming evidence. So there needs to be, people seeking, even the person presenting has to be seeking for contrarian feedback. He has to expect it. And that can lead to heavy debates. And so you need to have a group of mature people that can get along, even though we have a heavy debate. When the committee is over, everyone can get along. So not every people are able to do that. And one funny thing is we still have it. We have the devil's advocate practice where we could, when there's a new investing idea that is expected to be shown at the committee, we would pick a name in a bucket, and that person would be the devil's advocate. So its only mandate is to be short on the stock and figure out all the bad things he could say about the thesis. And what we've noticed is that over time, we don't really need to pick a name because the four other ones are actually devil's advocate. And even the person presenting the idea is a devil's advocate in itself because he would lay out the positive and he would talk about the risk because what better ways to lower the level of debate than by yourself as a presenter saying what doesn't work in my own thesis. So yeah, I hope it helps a bit your audience to figure out the devil's advocate practice.
So I wanted to take the opportunity in this interview to discuss a couple of Medici's holdings. So being based in Montreal, you inevitably discover some of the companies north of the U.S. border, one of which is Dollarama. And Dollar General has been talked about quite a bit over the past year or so in the U.S., given how the share price has performed. So when I looked at the returns for Dollarama and Dollar General, it's like a night and day difference over the past 18 months, which was honestly quite a surprise for me. Generally, you'd think if there's a slowdown in retail more broadly or some pockets of retail, it'd be affecting many of the players. So when you look from the start of 2023, shares of Dollarama are up over 60%, while shares of Dollar General are down around the 50% range. What is Dollarama doing that's different than Dollar General?
Yeah, I certainly know Dollarama a little more than Dollar General, but we have visited Dollar General quite a few times when we come in the United States, so I could definitely comment. Dollar General, they have a wider selection of consumables, whereas when you look at Dollarama, within the consumables category, they will only have the low price, best deals items that they can find out. Dollar General, they will bundle offers and do promotions. Dollarama, you don't see any promotions. You see everyday low price, no advertising. There's absolutely no advertising. Dollar General, there's many formats for a single items. Dollarama, almost no big size, especially in the grocery category. You will find a small size. If you want more, you buy 2, you buy 3. Dollar General, their core audience, from what we understand, maybe we're not totally right about this. These are people buying their grocery, shopping grocery, where there are sometimes not any other options, small villages. Dollarama, the core audience is people that need everyday stuff. Housewares, cookwares, staples, electronics, arts and craft, toys, tools, and so on. So it's really a general merchandise store. The people that are, economically constrained, they might want to shop grocery, but they're not the core audience. They're the minority. So I guess, from the top of the building, there's many, many differences that I see, but I could lay out the difference with the result in the margin, if you wish so.
Yeah. So I have here that Dollarama's net margins are around 17%. And then contrast this with Dollar General, their margins are down, net margins are down to 4%. They were ranging around 6 or 7, so they've come down with some of the slowdown they've been experiencing. Why is Dollarama's margins? Why are they able to command such high margins?
Great question. At Medici, we're joking that Dollarama is amongst our best software company within the portfolio because they have software-like margins, but there's nothing related to software. Maybe the use of some software, definitely, but it's not a software business. So again, Dollar General, 81% of their revenue mix comes from consumables. And we know consumables are lower margin product. At Dollarama, it's 46%. So base rates, Dollarama, if they had, just that difference, there would be a better margin for Dollarama. Dollar General, they have grocery stores like margin. Dollarama is not a grocery store. Dollar General, 4% of their revenue comes from direct imports. So most of the stuff, the inventory that's coming in at Dollar General is coming through a distributor, and you have to pay, the distributor is cut off the profits. Dollarama, 50% of the products comes from direct imports. So that's a huge difference. Dollar General, you will see a heavier mix of national brands. And so if you buy national brands, there's maybe less bargaining power that you can flex with those big players. If you visit a Dollarama store, you'll see that there's a much higher private label mix. Dollarama is known for their knockoffs. You look at the chocolate bar stand, you won't see any Mars chocolate bar. You'll see Meteor, which is absolutely the same thing, but it's not made by the company that does Mars. And they like to keep it simple at Dollarama. There's no frozen food. There's no fresh food. So the energy bill inside the store, inside the distribution infrastructure is much lower because of that. The logistic, think about it, you have no fresh product. You have no refrigerated product or frozen. So the freight, the transportation, you transport by train, it's cheaper. You don't need to transport every 1 or 2 days because you have no fresh food. So it's less freight intensive. So it's less expensive to move stuff. The beverage inside the stores, they are almost all on the shelves. They're not refrigerated. And they're the perfect concept for self-service cashier. Because there's no age-restricted products. There's nothing being sold by the pound, so you don't need to have a balance and with a code that you input on your checkout. Everything has a barcode, so the throughput can be really fast on self-checkout, and you can get labor efficiency because of that, that keep it simple style. And even when setting price, many of the items that they will sell, they have their own price tag printed on the packaging. That means the product would sell at the same price in every store, whether or not the store is in Toronto or, in Sudbury. And, in Canada, there's not much room for a new entrant. They already densified their footprint inside the major cities. The competitive landscape is much easier also. The dollar stores industry is 50% less penetrated in Canada than in the US. So there's still room to grow, but they have scaled up. Dollar Tree is the biggest competitor with 250 stores in Canada, and they're not growing. And Dollarama is more than 6 times that amount. So it's just, the moat is just too big. And, if you want to compete Dollarama in Canada, the best way is you would have to buy Dollarama. And since they're publicly traded and they have, quite a nice multiple, I guess there's no one willing to do that.
So we talked earlier about the power of high reinvestment rates at high returns on capital. I see returns on capital for Dollarama are in the 20% range. And it's been, quite a strong performer over the years. But I look at their financials as of late, and I see that a lot of their operating cash flow is being deployed to either paying down debt or share repurchases. And then they do have a bit of growth CapEx. So I'm also interested in hearing your take on your outlook for the company from here and what you see in terms of store growth and maybe what keeps you holding on to the stock, essentially?
Yeah. The stores are leased, and so they don't spend on real estate that much, which can be quite expensive in terms of CapEx when this is the case. And so the CapEx are minimal. It's lease improvements, it's equipment, systems, green and yellow signs inside stores. So it costs less than $1 million to open a store, at least in Canada. So I guess the reason it looks like they reinvest not quite much of their money in opening store is solely because it doesn't cost a lot. If you enter a store and you look at it, it's there's nothing fancy about it. It really doesn't cost a lot. And the other thing is maybe an accounting issue. It's not an issue. It's just the way the accounting works. They own 50% of a business in Latin America called Dollar City, but it's reporting at the equity method. So if you look at CapEx, the CapEx bill, it will only be the CapEx for opening new stores in Canada. But they're opening quite a good amount of new stores inside Dollar City. But since it's at the equity method, it will only be reported on the cash flow statement when Dollarama Canada will put in new money inside Dollar City. That does not happen. It happened maybe once or twice over the last 5 years. So you won't see it. So there's probably more CapEx, adjusted CapEx that you would see. And just to give you a good idea, Clay, the store count in Canada is growing 4 to 5% every year. But if you bake in the pro rata shares of Dollar City, it's more like 7 or 8% a year. That's quite a good clip, a good growth pace for a business, 7, 8%. So we feel like they're running as fast as they can, but they still have the luxury of having excess free cash flows. So it's reasonable to think that, they'll continue to do buybacks, although they'll probably try to keep the leverage stable or maybe a little lower. And from an historical perspective, it's hard to blame them for repurchasing shares because the stock went up 30% CAGR since their IPO, I think 14 or 15 years ago. So we can blame them for that. From our opinion at Medici, we would tend to think that we would prefer to see them buying back opportunistically, although there are not much opportunities, and keep maybe a little more cash for eventual and adding new countries, international expansion. But, again, I think it's pretty fair what they do with the capital. Yeah.
Yeah. Thank you for expanding on that. That makes sense that they're able to grow without a lot of potential reinvestment, which is also a very great position to be in when looking at a company. One of the other big winners in your fund has been Meta, which in my opinion is one of the most interesting case studies of investor sentiment over the past few years. So today, Meta shares are just under $500 a share. And in November 2022, it was under $100. So we're up over 5x in just under 2 years. But this was not an easy stock to just hang on to. When I look back at 2022, revenues declined in 3 straight quarters, which, is just a gut-wrenching period for investors that are used to a company that was growing at 30% plus for many years. And today, you still have a large stake in Meta, to the best of my knowledge, which I think is a company you added to in 2018 during the Cambridge Analytica scandal. And then in 2023 alone, you had outlined in one of your investor letters that Meta contributed 6 percentage points to your returns in 2023. So obviously, it's been a key contributor during the year alongside companies like Constellation Software, Lumine, Amazon, and Alphabet. So given that Meta is still a sizable position today, talk to us about what you're seeing in the company and what keeps you in it.
Yeah. I think it's maybe fair to start with a little bit of context on what happened in 2022. So yeah, revenue did decline if you look at the numbers. If you exclude the FX impact, it was growing slightly. Although not up to the amount that you've alluded in your question. And still growing despite the COVID overhang, the mean reversion of digital advertising, the TikTok emergence, Apple's privacy change. So that was a lot of face wind. And yet Meta was still able to grow XFX top line. So I think that speaks volume about the quality of the business in terms of, numbers. And the other issue was the major deleverage, by the way, where they were pursuing a lot of hirings and the metaverse expense that were getting a little bit out of control at that time. And, maybe Zuckerberg was caught into the fear of missing out as the digital economy improved with the COVID. He says, well, maybe we need more staff down the road, and my competitors are doing the same thing, so let's do it. But he self-corrected pretty quickly and recognizing that he went too much with hirings. And it became clear, by the way, when the layoffs happened in December 22, that the stock was still super cheap, but we would see leverage coming back over the next few quarters because laying off 20% of your employees in a business like this one with leverage, that's magic to the numbers. It's really magic. So in order for that to be a good investment at that time, you had to be able to recognize that, the layoffs would be magic. And the market did, yes, the stock went up with the announcement, but we were like scratching our head and like, why is it not going up more? And so we were really bullish at that time. And it had less than 10 times earnings multiple. So it was really a great investment. But you had to figure out that those things were mostly temporary, which was not that easy to do.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
So, circling back to competitive advantage, if we exclude WeChat, which is a network where the vast majority of users are China-based, which is not an addressable market for Meta. Meta owns 4 of the 6 most popular social media websites by monthly average users. Facebook is number 1, WhatsApp number 3, Instagram 4, Messenger 6. So there's YouTube and TikTok, which they don't own amongst those 6. So every new initiative can be leveraged into these 4 platforms that no one else has. It can even, if you think about Threads, the network they've launched, which is, quite similar with X, Twitter, it can even increase their odds of winning on that network because, they're intertwining it with all the other platforms. And so they are built to win in that regard because of their, outrageous dominance of the social media environment. And if you think about competition, you might have a chance of building the next TikTok. But how about building 2 or 3 platforms like these? What are your odds of success? We think it's likely 0 for the short, mid, and even the longer term. Again, think about it. The high cost burden. There's the algorithmic feed. That is, today, it's not based on social graph. If you want to create a good feed, it's going to be based on computing power and generating and figuring out what is your interest with the information you get from the app. So it takes at least 2 or 3 years to figure this out and many $1 billion worth of CapEx. You need to build a user network. So you need to have good content. And if you want to have good content, well, you better be lucky. Or you better, maybe have some form of content subsidization, subsidize. And that costs money again, probably a couple $1 billion again. Safety and security. Meta has invested $20 billion since 2016. $5 billion alone in 2023. Okay, it's not like 10 years ago. You need to have safety and security. There's election integrity. There's undesirable stuff happening on the platform. And if you don't do the investment, you could have hefty fines from the European Commission. And those fines are based on your international revenue, not your profit, not your local profit. So really the revenue. So it could be quite risky for a new platform not to do those investments. So again, it costs many $1 billion. And I think it's just hard to scale quickly. The monetization, it's hard to figure it out when you don't have the advertiser base. And Zuckerberg has mastered the art of monetizing, but that you will have Zuckerbergs against you trying to monetize faster than you. So good luck. And then maybe the last one, the safety and security is going to slow you down much more than it used to be the case 5 and 10 years earlier in the past. And so without that, it's hard to figure out how Meta's moat could be, greatly challenged. Google Plus tried, Google, and they had the financial capacity. They had many other tools that they could intertwine it with, the Google account, the Gmail, the Maps, and so on. And yet they failed. TikTok had its chance, Snapchat also. TikTok risked being banned in the US. And what have they done in security? I'm not sure they have done enough. It's probably easy for me to say that today. But Meta pretty much closed the gap on the Reels. So I'd say good luck for the next one who would want to challenge Meta on that. I think we're probably close to a golden age of social media. And Clay, I could talk about the growth opportunities if you wish. Depends on.
Yeah. So I think part of the Meta story and the shift in narratives is almost like a shift in capital allocation and, where they're focusing their attention. So, throughout the 2010s, you could say pretty good capital allocation. They focused on kind of what they were really good at. And then Zuckerberg had this big shift in his focus to the metaverse, where he spent $40 billion and a lot of shareholders, or I guess the narrative was that he's just throwing money down the drain. And what's the use of all these cash flows if he's just going to throw them towards something that, potentially shows no promise of any payoff at all. We'll see. But maybe you could talk about, the growth opportunities and then how Meta approaches capital allocation in 2024, given these lessons they've learned over the past couple of years with regards to the metaverse.
Yeah. So the growth opportunities, there's the use of AI. It's just too big not to talk about it. There's probably 5 elements within the use of AI. The first one is they will increase internal efficiency. So security, programming, less labor intensity. Second one, they'll increase the ROI on advertising. So we see it with Advantage Plus, the quick audience testing, finding the best visuals, the best text, as the AI learn about how you publish stuff. It's going to be meaningful. Third one, increasing the recommended content. So we already have proofs that the recommended content increases time spent, and then the ad load, if we can say it that way, versus the social graph. And they already made the CapEx to have more recommended content. So it would likely help them grow further. 4 is the offering of free AI tools to users. And 5 is, and it's unmonetized for now, the AI tools, but we'll see later down the road. And 5 is really selling a virtual customer service agent to businesses. So it's a whole new addressable market. If you think about it, you would be replacing human labor or some of your human labor to do customer service, and you would replace it for probably a fixed cost or a monthly cost, and it will probably be a fraction of the salary of a human. That's major if you think about it, and that's a key for even Meta, if they wish so, to not get out, but diversify from advertising, selling another kind of services to businesses. And outside of AI, there's click-to-message advertisement that is going well. There's business messaging on the WhatsApp. Instagram is still growing. You see it in court filings. We have had the numbers from Instagram. It's 30% of their revenue base, and it's growing mid-teens, even in the 20s. There's $46 billion in cash, despite $37 billion in our annual R&D, $16 billion of metaverse losses, $27 billion of CapEx, and yet they still have amazing margins. Pre-R&D and pre-metaverse loss on the income statement, they have a 80% EBIT margin business. And so most of it is discretionary in terms of R&D and metaverse. And the business still returns, 15 to 20% return on capital despite all that. So yeah, Clay, I agree with you. There's a bunch of CapEx that are being done, and we're not too sure about the outcome, but yet still, it's a really nice business, even with all those, spendings. And I think I'll have to quote Zuckerberg on the Q4 2023. He said, "We're still well positioned now because of the lessons that we've learned from Reels. And I decided that we should build enough capacity to support both Reels and another Reel-sized AI service that we expected to emerge, so we wouldn't be in that situation again. And at the time, the decision was somewhat controversial, and we faced a lot of questions on CapEx spending." So those elevated CapEx that we've seen over the last 2 or 3 years, Meta went from playing defense to playing offense in 2 short years. That's amazing. And it wouldn't have been possible without all those CapEx. And Zuckerberg, he works both on the long and the short term. He's been buying back $63 billion worth of stocks within that period. Maybe his timing wasn't perfect, but the average price he paid for those buybacks were probably quite interesting. And so those elevated CapEx, they are totally fungible. Most of that is servers and computing power. They'll be able to train much bigger, AI models, recommendation systems, upcoming AI tools that you would want to create. They'll have the capacity to do that. If it doesn't pan out, they could improve safety. They could monetize trends faster. They could create new tools for advertisers. So I don't think in our era, it's a sin to have, more computing capacity than required. It's probably a great asset to have today in our technological era. And maybe the last point I want to touch on for that question is the metaverse. So many people see the metaverse or Facebook Reality Labs as, it will work or it won't. But it's not a single project, There's the haptic or neural command systems. So how do you communicate with your device using not your voice, no keyboard, and maybe a wristband? Okay, that's what they are likely going to do. There's the AI investments, and it's already contributing to the core business. And AI investments was originally from Facebook Reality Labs. There's Horizon, the social media, immersive social media. The augmented reality device, such as the Ray-Ban glasses, they're selling it out. They're quite popular. and the immersive experience inside of businesses. If you want to meet people, you're a multinational, you want to meet with your partners, but they're at the other end of the world and you don't want to travel by plane. Well, they have a partnership with Microsoft for that. So there's some stuff within Facebook Reality Labs that are going to be useful, and some other stuff, probably it will be a write-off. We'll see, but it's not all black and white.
I think this transitions well to my next question on one of my favorite mental models from Warren Buffett. He says, if you don't plan to own a stock for 10 years, don't even think about owning it for 10 minutes. And I'm also reminded of Jeff Bezos talking about focusing and betting on things that aren't going to change, instead of asking what a lot of people are going to ask is like, what's the next big thing? What is going to change in the future? So maybe you could talk a little bit about how your team gets comfortable with how much change a business like Meta could be seeing over the next 10 years.
Yeah. It's not an easy question. There's two major forms of change that we have to contemplate. The first one is new forms of content. And we've seen it historically, switching from text-based status to stories, stories to short-form videos. So I think we've got a great track record from Mark Zuckerberg and his team that they have the assets and the capabilities to ride on those change. And especially with those CapEx that we've talked about, they have, many computing power that allows them to be able to be in front of the next change that will happen. And those change might happen, 2 or 3 times over the next decade. And, we're pretty confident on how Metas will adapt to it. The other form is really the form factor. So for example, switching from a desktop to mobile, that was a form factor. It doesn't happen every time. It might not even happen within the next 10 years. So riskier, lower occurrence. And for us, it's still unclear what's going to disrupt the mobile phone. The glasses, the mixed reality headset, there's still engineering issues. The expert that we've consulted on that is the battery packs, the size, the heat that's on your face, the weight on your head, the fact that it's highly immersive and it's big. They'll probably figure it out someday, but they don't have the solutions right now for all those challenges. So the change in the form factor might not be coming over the next, 3, 4, 5 years. It might take a little longer. And apart from gamers, it's still unclear what are the great use case of having this immersive experience with Quest or the Vision Pro. And maybe some people thought that the watch could eventually disrupt the phone, but clearly Apple has taken on that market, and Apple is wise enough to not cannibalize its own phone, and they made it an additional tool that you might want to use, but concurrently with the iPhone or jointly with the iPhone, I should say. If you think about Mark Zuckerberg, he's 40 years old. He should already get an award for its proven capacity to react to change. All the shift that we talked about, desktop to mobile, text to pictures, to stories, to short form video, the political turmoil, the election integrity, those were massive crises that they had to invest in security in a major way. The fight with Apple's privacy change. And today, the algorithm with recommended content is even stronger than before with the cookies and the tracking technologies. I mean, he already gets a huge award for its capacity to react, and he's probably not even at its prime. He's proven also that he's trying to make profits. You could be a good visionary and adapt to change, but not make a profit, and you have to adjust all this and that on the income statement. He's not in that business. If he hired too much, he would lay off people, and the main reason that was cited is for nimbleness. Again, that capacity to react to change, having less staff on board, and the capacity to buy back shares. Not everyone is able to seize that opportunity when the stock is going down, and he reacted quickly. So I guess as long as Zuckerberg is in control, we'll be fine.
Yes, love him or hate him, what he's done, and to be able to start such a incredible company at such a young age is just quite remarkable.
And still being at the helm, by the way.
Yeah.
Because the skills you need at 20 years old to build from scratch a company, and the skills to operate a company with many 10,000 employees, wow, that's not the same thing. It's quite different.
Yeah. Each stage of their growth requires very, very different skill sets. So you own 3 of the US big tech companies. You have Meta, Alphabet, and Amazon, if I'm getting that right. Which of the 3 do you foresee to have the strongest growth prospects in the underlying business over, say, the next 5-10 years?
That's probably the hardest question that you're going to ask me today. Super hard to figure out. They're all highly powerful, dominant businesses. We feel like Meta and Amazon are pretty close to each other in terms of, longer term future growth. And Alphabet is probably on the 3rd rank, although, it's really a great business and we own it. So starting with Amazon, they own the rails of e-commerce, and they have the ability to be the most convenient player. And for anyone who would want to be as convenient, as quick on delivery, and at the lowest cost, there's many $billion separating them from that. And so I guess they would probably be still dominant in e-commerce, in 10 years. And e-commerce is still growing and taking shares from traditional retail commerce. E-commerce as a percentage of retail sales in the US went from 10% to 16% over the 5 last years. And it's pretty much the same trend in the rest of the world. And this is growing high single digits. And so if you can keep your moat and get that growth, you could have quite good results. So we think Amazon is gonna win in terms of e-commerce. Alphabet, Google, they're probably the greatest business in modern history right now. They're a tool bridge on the internet search queries. They're a monopoly, even though they might not want to say that publicly. They're so powerful, but the regulators are both ends on the search business. They're going through massive litigation. Antitrust authorities in the US and the EU are on their back. The search and Google network is about 2/3 of their revenue. Gemini will definitely, like I said previously, get their fair share of search, but they will be maybe an oligopoly, and passing from a monopoly to an oligopoly, it's still, even though it's quite good, it's still a downgrade from your previous state. And so there could be, a multiple contraction. And, if you think about everything else Google does, pretty much everything they does outside from search is having less margins. And so we could also expect margin contraction. So what we do at Medici, we would really make sure to bake in margin contraction and not rely too much on multiple expansion in order to figure out if we're willing to own it or not. And as of today, it is still the case. But as we go further down the road, it might not. And we try not to hold too many Alphabet, Google, and Meta at the same time, because both business are getting their profits from advertising, digital advertising. So it's a way to mitigate risk. And, we choose to put most of our dollars, or limited digital advertising dollars in Meta for that reason.
I wanted to transition and talk just briefly about one more name. So when I first started out as an investor, it was easy for me to get attracted to higher growth. So looking at the Metas, the Alphabets, the Amazons of the world, and many other companies we could list. Because you think if a business isn't growing, then how can the stock perform well? Well, then you run into companies, one of which that we mentioned earlier was O'Reilly Automotive, and they seem to greatly defy this logic, growing in the mid to high single digits, and the stock has been, it's performed spectacular. There's no doubt about it. Talk to us about O'Reilly Automotive and what makes them such a special business.
Yeah, well, there's three or four dominant players in the U.S. There's Napa, there's Advanced Auto Parts, AutoZone, and O'Reilly. And O'Reilly, how they laid out their distribution infrastructure is many of their DCs are really close to bigger cities. And it's been more expensive to build them that way. But what we get from that is they are able to deliver in a much more frequent way than even the other big players. And again, those big players that I just name drop, they are about 50% of the market. And so they're displacing regional players. And what's great about that business is many retailers, you need to have the best price to win. O'Reilly and the industry of aftermarket automotive part, you want to get on with your life when your car has a problem. And you're not willing to, if the parts are available right now, you're not willing to shop and see at 2 or 3 different places where will be the best price. You just want to get on with your life. And the same thing for the repairman, the technician. He wants to turn his base, and he's passing the price of parts to the end user, the driver. And so if he can get the parts quickly, he would turn his base faster. And generally speaking, the technicians that repair cars, if they turn their base quickly, they will end up having a better salary and better bonus than if they're not. So having the good partner that can deliver to you quickly is critical. And if you think about, for example, AutoZone, which is probably the best peer since by numbers, they get great results too. Their distribution infrastructure has been planned for do-it-yourself. So the people that own cars and want to repair their cars by themselves. Not so much for the technician industry, so the do-it-for-me industry. And if they want to win with that, they have major infrastructure, distribution infrastructure work to do, and that will cost a lot. They'll probably do it, but they would need, at least 5 years to maybe, narrow the gap with O'Reilly. And so seeing that moat is great. But again, circling back to what I said previously, we we could have thought that, the pie isn't growing. There's so many auto stores in the US and there's not any more growth. But if you got a really greater ability to win versus your competitors, what it ends up doing is you're displacing competitors. So you can keep opening your stores. Your payback isn't going down much. And if you see it going down, you can slow down on stores opening, but that's not what's happening with O'Reilly. They keep opening stores, even though it seems mature, and the return is still good. So even though the pie is not growing, well, they're just able to steal market shares. And we see it. If you read the calls, you listen to the management, you ask them questions, they're clearly gaining shares. And so I guess, I don't know, we like the fact also that it's anti-cyclical. If there's a major recession coming tomorrow, yes, maybe the first month, people will freeze. And O'Reilly will get bad results for that given quarter. But they're probably the first ones to get back because people just stop purchasing new cars and repairing their older cars. And then they're the, direct beneficiary of that. And so, we want to be fundamental investor. We want to remain calm when there's stuff happening in the economy and be able to make good decisions. But having a few stocks like these ones that are more stable can help you remain calm in that kind of environment. So having an O'Reilly in the portfolio is great to have. Yeah.
One of the other things that sort of sticks out to me with O'Reilly is the consistency of buybacks over such an extended period of time. And when a company is undervalued, persistently undervalued, and they're consistently just buying back and eating up the shares, it really makes a big difference in your returns over the long run. So how much did buybacks play into your thinking of buying and owning something like an O'Reilly?
I'm not sure it did have any impact. We're quite happy to see them do that. We think it's more efficient than paying a dividend, just for tax reasons. And they're probably running as fast as they can, as fast as the market can bear, and as fast as, you need to hire people, you need to find good store managers, you need to find good real estate. And so that's stuff that it's hard to open, 10% new stores every year. So of course, and since those business, makes tremendous cash flows, of course you've got excess cash flows, and seeing them buying back shares is probably a good use of capital. Eventually they have to go international. They are already doing it. They bought the business in Montreal, Canada, close from us. And they expanded in Mexico, and they took really the time to test before they started growing in Mexico. And that's the kind of approach that we like. We've seen Target in the US trying to come up in Canada a few years ago and trying to buy all the Zellers stores. And it was a major failure, I think 6 months after they were leaving. And so if you want to build if you want to expand internationally, the good way to do it, at least in Quebec, the great businesses that we know that have had success doing it, they buy a business there, they find a great management that's already there, and they build with them. And they test the approach, they don't go too quick. Alimentation Couche-Tard in Quebec is pretty well known for that. And so we like the approach. We think it takes a long time to see them ramping up internationally, but we think they'll eventually succeed. Yeah.
Wonderful. Well, Pierre, I greatly appreciate you joining us on the show here today and being so generous with your time and sharing more on your process and holdings. at Medici. Please give a handoff on how the audience can connect with you and learn more about Medici if they'd like, and anything else you'd like to share while we're here.
Yeah. Well, thanks a lot, Clay, for having me. I sure hope your audience have been able to appreciate my plain English. But, if people want to reach us, they can go on our website. It's gpsmedici.ca. We've got a light English version, but since, the vast majority of our clients speak French, there would be an enhanced version with lots of media content in French. But the translators are pretty efficient today. So I guess any curious investors would be well advised to go on that section of the website. You can subscribe to our newsletter, and we're able to serve investors residing in most major Canadian provinces. So anyone interested, feel free to shoot us an email or give us a call, and we will get with the inquiries.
Great. Well, I'll be sure to get all that linked in the show notes. And Pierre, thank you again. I mean, this was great, and I know the audience is really going to enjoy it. So thank you.
Oh, great. Thanks, Clay.
Many cheap businesses are rightfully cheap and can always get cheaper in the future. And many expensive businesses are rightfully expensive and can get even pricier in the future. The most important part of this, according to Fisher, was to nail down the likelihood of a business continuing to grow in the future. If you know the business will continue to grow, especially for multiple years in the future, you can justify paying a higher price. But you must be certain that this will happen. I think this is why Warren Buffett places such a large emphasis on certainty during his analytical process. If he lacks the certainty required to understand whether profits will be higher in the future, he'll simply throw the business in the too hard pile and move on to something else.